You're sitting at your kitchen table, coffee in hand, scrolling through your phone, and suddenly you see it. Markets down 4% today. Recession fears surge. Investors panic as global stocks tumble. And just like that, your stomach drops. You open your investment app, you look at the number, and a little voice in your head says, "Should I just pull everything out? Is it safer to just wait?" If that sounds familiar, this video is for you. Because here's the thing, that moment of panic, that's not weakness, that's human. But what you do in that moment, that's what separates investors who build real wealth from those who just break even for decades. So today, I'm giving you the exact 7-step checklist that smart investors run through every single time markets get nervous. Let's get into it. I know, that sounds counterintuitive. We're wired to act when there's danger. It's survival instinct. But here's a surprising stat. According to a study by Dalbar Inc., the average investor earns about 3.7% annually, while the S&P 500 averages around 10%. Why the gap? Because average investors move when they should hold. Think of it like this. Imagine you own a rental property. One week, someone on the street tells you property values dropped. Do you immediately sell your house? No, you wait, you think, you look at the fundamentals. Your portfolio deserves the same respect. So the first item on your checklist is this. Before you do anything, pause for 48 hours. Set a rule. No trades during a panic. Just wait. Now, you might be thinking, okay, but what if this time is different? What if it doesn't recover? Fair question. Let's look at history. The 2008 financial crisis, the 2020 COVID crash, markets dropped 34% in 33 days. The 2022 inflation sell-off. Every single time, the market recovered. Every single time. But here's what most people don't realize. The investors who got hurt weren't the ones who stayed in. They were the ones who sold at the bottom and bought back in at the top. So step 2 is this. Write down, literally write down why you started investing. Retirement, a house, your kids' education? That why doesn't change because a headline scared you. Reconnecting with your purpose is the most underrated financial tool there is. Okay, now let's get mathematical, because most people feel like they're losing everything, but they haven't actually done the math. Let's say you have $50,000 invested and markets drop 15%. That feels terrible. That's a $7,500 loss on paper. But here's the key word. On paper. If you don't sell, you haven't lost anything yet. You're just looking at a temporary price tag. Now, if you do sell and then wait to feel safe before buying back in, you might miss the recovery. Missing just the 10 best trading days in the market over 20 years can cut your returns in half. Half. Step 3, calculate your actual dollar exposure, not just the percentage. Then ask, can I live with this number being temporarily down for 12 to 18 months? If yes, you're probably fine. If no, that's important information about your risk tolerance, not a reason to sell, a reason to rebalance. Here's something most people skip, and it costs them big. A lot of investors panic sell their long-term investments because they don't have enough cash on the side. They need that money, and when life gets expensive, job uncertainty, unexpected bills, they liquidate at exactly the wrong time. The rule is 3 to 6 months of living expenses in cash, liquid, accessible, not invested. If you have a $4,000 per month lifestyle, that means $12,000 to $24,000 sitting in a high-yield savings account, not in stocks. Think of your emergency fund as your financial immune system. When the market gets sick, your immune system keeps you from making desperate decisions. Step 4, open your banking app right now and check that number. Is it there? Good. Is it not? That's your first priority before any investing strategy conversation. Now, here's where it gets interesting, and I mean genuinely exciting if you shift your perspective. What if I told you that market downturns are historically the best buying opportunities of any given decade? Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." Let's make that concrete. If you had invested $10,000 into an S&P 500 index fund at the bottom of the 2009 crash, right when everyone was panicking, by 2021, that investment would have grown to roughly $75,000, a 650% return. Most people did the opposite. They sold in 2009 and bought back in 2013, after missing most of the recovery. So step 5 is this: make a watch list of 3 to 5 quality assets you've always wanted to own but thought were too expensive. A market dip is your alert system. It's the sales sign on the window. You wouldn't avoid a store because everything just went 20% off. Don't avoid the market for the same reason. Here's something nobody talks about. In volatile markets, your media consumption is as dangerous as your portfolio allocation. Studies show that financial news networks increase fear-based language by over 30% during market downturns. Why? Because fear drives clicks, fear drives views, not your financial well-being. If you're checking the market 12 times a day, you are manufacturing your own anxiety. Step 6, limit market news to once a day maximum. Unfollow the accounts that post every red tick like it's the end of civilization. Follow long-form analysts. Read quarterly reports. Think in years, not hours. The best investors I've studied don't have faster information. They have calmer information habits. Here's the final step, and it's the most powerful one. Don't be passive. Don't be reactive. Be intentional. Pick one concrete action from this checklist. Set up automatic monthly contributions so you buy more shares when prices are low. That's called dollar cost averaging. Rebalance your portfolio if one asset class has drifted too far. Move 10% of your next paycheck into that emergency fund. Open a position in one undervalued asset on your watch list. Just one. Then close the app, go for a walk, cook dinner, call a friend. Because here's what most people don't realize. Wealth isn't built in the moments of market chaos. It's built in the decisions you make quietly, while everyone else is panicking loudly. So let's recap your checklist. 1. Pause 48 hours before any emotional trade. 2. Reconnect with your investing why. 3. Run the real dollar math. 4. Audit your emergency fund. 5. Build your on-sale watch list. 6. Clean up your information diet. 7. Make one intentional move. Then step back. That's it. 7 steps, not complicated, but powerful if you actually do them. Markets will always get nervous. That's the nature of markets. The question is, will you? If this video gave you even one useful idea, do me a favor, share it with one person who needs to hear it right now. And if you want the full investor psychology deep dive, the next video is right here. I'll see you there.